How to trade volatile markets. That's a topic for discussion today in the episode 20 of How to Become a Successful Trader from Market Secrets. So, how to trade volatile markets? Your first priority in trading is to protect your capital. There is nothing more important than this. This is your seed capital and you cannot afford to lose it. So if you think market is too volatile today due to some events like budget or election results and you are nervous about taking trades, you should stay away from the market on that particular day. Anyway, a professional trader will have daily targets and will stop trading after their daily target is hit. So there is nothing huge they can gain from the market on that specific day, but if they lose big due to high volatility, it will leave big dent on their capital. So stay away from market on high volatile days if you aren't ready for it. Also, you may have heard that when setting a stop loss, you should allow more room for volatile price action. People would say you should widen your stop loss on the basis of volatility of the market. I strongly disagree. Never increase or widen your stop loss ever. It will affect your risk reward ratio and will affect your balance and would end up hurting you. So, how to handle volatile markets? You should consider using staggered stop loss. It means instead of using a single stop loss, you can use multiple stop loss for the same trade. There is no specific rule that states you have to set your stop loss on your entire position at one price. You can use staggered stop loss, which will give more room for volatile price action and will give you a better chance at maintaining at least a part of your position should the trade move against you. And you can achieve this without increasing your risk or stop loss. For example, let's say you trade on a specific stock regularly and you use 50 point as your stop loss and you generally trade 100 shares. In this case, you have two options to set the stop loss. You can set 50 point stop loss on all the 100 shares and if it hits that level, you are out. A more conservative approach, especially in the volatile markets, would be to set three different stop losses. We can set first stop loss at 30 point loss for 33 shares and the next stop loss at 50 point loss for 33 shares and the third stop loss at 70 point loss for the rest of the 34 shares. Your total loss in both the cases would be the same, 50 point per share for 100 shares, which is 5000 points in total. But the second option would give you a chance to stay in two-thirds of the position above a 50 point loss and maintain one-third of a position even if the price drops by 50 or 60 points before bouncing back. So we can use a staggered stop loss to reduce the impact of volatility in our trades. But people use even the staggered stop loss in the wrong way. They use staggered stop loss in a way which increases risk. For example, if you take our scenario 2, some traders would place staggered stop loss like this: 50 point stop loss for the first 50 shares and 70 point stop loss for the remaining 50 shares. This will increase their overall stop loss to 6000 points, hence affecting their trade plan and their risk reward ratio. If this works one time, they will keep on repeating this and without even knowing, they are messing up their trade plan big time and they are indirectly increasing their stop loss. So what do you think about staggered stop loss? Are you using it? And are you using it in this right way or are you using it in the wrong way like this? Let us know in the comment section of this video. Also, if you have any queries, comments or feedback about this episode, drop it down in the comment section. We'll be happy to address it. Hit the like button if you have liked this video and share it with your friends if you find it useful. Also, subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.